Welcome to this week's Financial Flash. There's a lot of talk lately about the big R word and whether or not we're headed in that direction. So, this week, I'm going to discuss three related topics. First, the formal definition of a recession. Second, why a stock market downturn is not the same thing as a recession. And third, the likelihood of a recession in the United States given the current economic environment, particularly considering the large amount of investment being made in artificial intelligence. Let's start with the definition. Many people believe that a recession simply means 2 consecutive quarters of negative GDP growth. While this rule of thumb is widely used, it is not the official definition in the United States. The official determination is made by the National Bureau of Economic Research, or NBER, which is a group of economists that tracks business cycles. The NBER defines a recession as a significant decline in economic activity that spreads across the economy and lasts more than a few months. Rather than focusing on one statistic, economists look at several indicators. These include employment, real income, industrial production, consumer spending, and business sales. In other words, for a recession to occur, the downturn must be broad and persistent, affecting multiple sectors of the economy rather than just one. This leads to an important point. A stock market decline does not automatically mean the economy is in a recession. Financial markets are forward-looking. Investors constantly try to predict future economic conditions, corporate earnings, and interest rates. Because of this, the stock market often moves months ahead of the actual economy. For example, stocks may fall because investors expect slower growth in the future. But the underlying economy, jobs, income, and spending may still be expanding at the same time. Likewise, the market often begins recovering before a recession officially ends because investors anticipate an economic rebound. So while market downturns can signal concern about future conditions, they are not themselves a recession. Now let's turn to the current economic outlook in the United States. At the moment, the economy shows a mix of strength and uncertainty. The labor market has remained relatively resilient, and consumer spending continues to support economic activity. At the same time, higher interest rates, inflation concerns, and geopolitical risks still create potential headwinds. One of the most important factors shaping the current economy is the massive wave of investment in artificial intelligence infrastructure. Technology companies and other firms are spending hundreds of billions of dollars building AI data centers, advanced semiconductor manufacturing, and high-performance computing systems. This type of investment directly contributes to economic growth. It creates construction jobs, increases demand for equipment and materials, and drives innovation across many industries. In effect, this spending acts as a major source of economic stimulus, even though it comes from the private sector rather than government policy. Because of this, many economists believe AI-related investment could help support economic growth and reduce the probability of a near-term recession. In other words, even if some sectors of the economy slow down, the scale of AI investment may provide enough momentum to keep overall economic activity expanding. That said, economic cycles have not disappeared. Recessions are a natural part of the business cycle, and risks remain. Changes in interest rates, global shocks, or a sudden decline in investment could still shift the outlook. In conclusion, it's important to understand what a recession actually means. A recession is not simply a drop in the stock market or a short-term fluctuation in GDP. It is a broad and sustained decline in economic activity across multiple sectors of the economy. While the possibility of a recession always exists, the current U.S. economy is supported by several strong forces, including continued consumer activity and unprecedented investment in emerging technologies like artificial intelligence. These factors may not eliminate the next recession, but they could delay it or reduce its severity. Thank you for joining me today. I hope this helped clarify what a recession really is, how it differs from a stock market pullback, and how current forces like AI investment fit into the bigger picture. As your portfolio managers, we're continually monitoring these trends and making adjustments when needed on your behalf. If you found this video helpful, be sure to subscribe to receive our weekly educational updates delivered directly to your inbox. Have a great weekend, and we'll see you in the next Financial Flash.
educational content by the professionals at Stiles Financial Services, delivering customized portfolios aligned to your unique wealth goals.